I'm joined now in the studio for more on this by Simon Derrick, Chief Currency Strategist at Bank of New York Mellon. Good to see you, Simon.
Good morning.
Thanks so much for coming in. So what do you think of the timing of S&P's warning coming as the deficit reduction debate goes on in Washington?
Well, I thought it was actually very timely. I mean, it's quite nice, and rather than waiting for 2 or 3 months after the event, that we get something that's actually up to date and to the point, and actually quite clearly is aimed at the deficit talks that are taking place at the moment. So from their perspective, yes, it was good. And I like to see that. What was interesting was the market's reaction to that, of course, because it was actually very muted. If anything, from the currency market perspective, we actually saw the dollar actually gain ground rather than lose ground.
And why is that?
I'd say it's because yesterday's announcement was a reminder to investors of the myriad of risks out there. And ironically, when you look at that and when people are becoming increasingly risk averse, it tends to be the dollar that people buy. Of course, there is also the broader issue that whilst we might be concerned about a possible downgrade of the US, there's no chance the US is ever going to default on its debt. And that's clearly not the case when we look at Europe, where at least the question of restructuring is being raised. So if it's a case of holding on to somewhere where they're on negative watch from a AAA grading, or somewhere where you might actually not get your money back, I think I'd rather take the first rather than the second.
And what do you think? Could it be a catalyst for meaningful change? Because right now, yeah, there's agreement, deficit needs to come down, but nothing on a clear path, a clear policy on exactly how to do it.
I think it's relatively unlikely. We've already seen the response from the White House. We know that this is about politics. I think that this will go the course. Yes, they'll raise the debt ceiling and they'll go from there. Could we see a downgrade of the US in the future? Yes, of course we could. But that's going to be a little while in the future. There's a lot of things.
How far along in the future are we talking?
Oh, I think we're talking a couple of years from here before we're really talking about anything meaningful.
The risk of a downgrade is there, even if it's not an immediate one.
Absolutely. But if you look at the world today, I'd still say that the US, relatively speaking, represents the best bet. And remember, it's the biggest and deepest liquid markets out there.
Yeah.
Relative to that, the Eurozone's the second largest market. It's difficult for investors in sovereign debt to find too much other places to really invest that are big enough.
It's interesting you're saying that, yeah, from a market perspective, it's a great bet right now. US isn't going to default. If anything, there's talk of restructuring right here in Europe. But is the market underestimating the US fiscal position right now? Because some analysts are saying, actually, this brings into sharp focus the fact that you've got US fiscal policy diverging from other AAA-rated countries. It's doing worse than its peers in the developed world.
Well, you could argue that we've been doing that for several years now. I don't think there's any surprises what we're seeing in the US right now. And again, the US attitude to the fiscal deficit is the same as it's largely been for the best part of a decade. So for anybody to be shocked that the US is following this course right now, I find surprising. But yes, maybe we are underestimating it. But I think if we look at the world overall, everybody's got deep problems, and I think for the vast majority of cases, the only two ways out of this are going to be printing more money, which I suspect is exactly what the US will do, or it's going to be talking about restructuring. Either way, it's going to be bad news.
So does the US deserve its AAA status?
Probably not. But relative to everywhere else, I still think I'd rather hold the US assets.
Will there come a point where, I mean, right now, bond markets, currencies, especially today, it seems to be all about Europe debt, those concerns really resurfacing. Will there come a point where US debt concerns will surpass those of Europe?
I don't think so. And again, I think it's down to this fact that ultimately the US can always print more money. So there's never going to be that point where the US is actually going to default. But I do think that one of the things we are going to see the further down the line is yet more QE, yet more printing of cash. And again, that is the concerns are going to be reflecting the value of the currency rather than the value of the debt. In the short term, over the next 6 months, I do think it's a strong dollar because I think it's going to be risk off. But in the longer term, if the solution to this is more printing of cash, then that is going to be a weaker dollar in the same way it has been for the last decade.
Simon Derrick, thanks very much for coming in.